Hello everyone, welcome back to Forex Signals TV. I'm Shane Vernier, market analyst at howtotrade.forexsignals.com. Today analyst Connor Woods and I will take a deep dive into the top 10 chart patterns that every trader should know. For legions of traders worldwide, chart patterns are a popular way of engaging the markets. However, not all traders are aware of the strategic edge that these technical tools offer. Do you know how to identify and trade a bullish Harami? How about a falling wedge or a symmetrical triangle? If not, you've come to the right place. In this video, our expert chartist Connor will show you how to trade 10 of the most powerful chart patterns in Forex, futures, shares, and crypto trading. He will explain how to locate and execute trades based on these high-octane formations. And then at the end of the video, we will rank 3 of our favorites. All right, that's enough for me. Let's head over to the trading lab and get started with our top 10 chart patterns.
So let's have a look at some examples now. Now, typically the falling wedge pattern comes at the end of a downtrend where the previous trend makes its final move. So in this example, we're going to look at the reversal trend and how we can catch that move to the upside. So here you can see a market which is typically trading to the downside with a series of lower lows and lower highs. Now, when we get these drawings on, we can see at the end of this downtrend, we have these converging lines, and that's where our wedge forms. Now, we want to wait for this breakout candle. When we get that breakout candle above our trend line, you can see that the momentum has completely shifted in the market, and now we're trading bullish and to the upside. So then let's have a look at an example on how we can trade this engulfing candle pattern. So they're intuitive, they're user friendly. What I like about them, you can spot them quite easily, and they occur quite a lot of times. And we can get these quick wins, these quick one-to-one wins out of these engulfing candles. Now then, in this example, we're going to have a look at the bullish and the bearish. So you can see that if we're looking at on this side here, we're looking at the bearish engulfing candle. So you can see we have this small bullish candle here. We have the bearish engulfing that comes after that, which pretty much swallows up that whole candle. And then we get that confirmation candle. And as traders would look to go short at that confirmation candle with a stop loss just above the bearish engulfing, and we can get those quick one-to-ones really nice and easy. We can see that there, one-to-one take profit hit. And if we scoot across in pretty much the same situation, we can see this bullish engulfing candle coming into play and giving us those quick wins, because we've got this small bearish candle here, then we've got the bullish engulfing which comes after it, which swallows up that candle, and then we have that really nice confirmation where we've had that now trend shift to the upside. And you can see that again, if the trader was to go long at the close of this bullish engulfing pattern with a stop loss just below the bullish engulfing candle, again, really nice one-to-one risk reward trading, and you can see that again, our take profits were hit on that regard as well. So that's how we can use the bullish and the bearish engulfing pattern to get those quick wins one-to-one trades. Okay, so let's look at an example on how we can actually trade the bull pennant in trading. Now, the bull pennants are continuation patterns which suggest we're going to get another uptrend extension. And you can see in this market now, we need to try and identify where that bull flag pattern is coming from. Now, what we want to identify first of all is the bullish market. We've got that here with this expansive move to the upside. Then we want to find that flagpole, and then we want to find what's known as a pennant, and that essentially is a period of price consolidation which shapes in like a triangle formation. So when I get these drawings back up on the chart here, you can see from this move, this expansive move is our flagpole, and the pennant is the consolidation, the triangle consolidation pattern that we have in between. Now, if we're traders looking to trade it, essentially what traders will do is maybe buy at the breakout candle that we have here. So if traders were to buy at the breakout candle in this example, with a stop loss just sitting below the low of the pennant, you can see that from there we've managed to actually have a really nice trade of a 6-7 risk reward trade, around a 7 risk reward trade, which is a fantastic trading opportunity, and that is how we can use that bull pennant to get that opportunity. So then let's look at how to trade these on the chart. Before we get started, it's important to emphasize that bull flag patterns apply to uptrends, so we're going to want to be focusing on the buy or the long side of the market. And there's two ways you can trade these bullish flag patterns. Number one is the breakout strategy, and this is what we see here. And before we do that, we need to identify the flag and the flagpole within this bullish uptrend. So as you can see, the market is trending up at the moment, and this initial move up is the flagpole of the market. And when we get that sort of consolidation period we have here, that's known as the flag, and you can really see the shape taking place here. Now, if we want to trade the breakout strategy, then we first need to actually look at where is the key breakout candle here. Now you can see as we've gone to move higher in this market, you can see this candle here is when we've broken above this flag level. So if we're looking at entries on the chart and we enter in a long position, we want to enter at sort of the closure of this breakout candle with a stop loss sitting just below the flag. Now we want to aim for sort of 1 to 1, 1 to 2, but you can see this particular trade actually managed to hit quite a significant 2.7, nearly 3 risk reward, and that's how we can trade the breakout bull flag pattern. So let's have a look at an example on how we can actually trade this hanging man candlestick. Now, trading the hanging man candlestick pattern is quite easy once we identify that bullish trend first of all, and that's when we get that hanging man candle formation appearing. Then all we need to do is find that entry, that stop loss, and locate that profit target. So you can see on this chart at the moment, generally speaking, we're trading to the upside. So what we like to do here is we like to find at the top of this, at the end of this upside trend, where we can find that hanging man. And if I get my drawings up on the chart now, you can see where this hanging man comes into play, because we've got big wick below, short wick above, and then we've got the body of the candle there. Essentially what we're looking for and how we trade that is we want to sell beneath the lower wick of that completed hanging man, and we want to put our stop loss above the upper wick of the hanging man. So this is an indication to us that potentially momentum is shifting. So we'll be short in the market theoretically at the bottom of the wick of this hanging man with a stop loss above it. So your trade is almost like the whole candle of this hanging man. And you can see that from there, we managed to have a fantastic 8.2 risk reward trade. And that's just from one candlestick, one formation of a candlestick, which is a fantastic way we can use that hanging man in this example. Okay, so let's have a look at an example on the chart now. Actually identifying this bullish Harami pattern on a trading chart is fairly straightforward and easy. However, finding the trading pattern is not usually enough, and what you'll need is potentially to combine it with other indicators. We're going to use the RSI indicator in this example. So what we're looking for is we're looking to find this bullish Harami pattern, and what we're looking for is a downtrending market, which we can see we've got here. The market's trending to the downside. And this bullish Harami is going to indicate to us that the market could be about to reverse. Now, what we want is, when I get my drawings on the chart, is at the end of the downtrend, what you'll see is this two candlestick chart pattern forming, this bullish Harami. And what we've got is we've got one bearish candle with a large body, and then we've got this second candle, which is a bull candle, but it has a small body. It's normally about roughly 25% of what the bear candle is. And if I zoom right in, you can see that. The reason it's not enough on its own is we want to use these indicators to give us some confirmation bias that the market is truly going to be reversing. And what you can see on this RSI indicator is we've got this RSI crossover where this yellow line is crossing over the purple line, which is an indication to us that the trend is starting to change. Now, as a trader, what we'd look for is we'd look for this second candle to finish positive, and we'd look at this second candle to finish bullish, and then we may enter a long position at the closure of this candle. The stop losses normally sit just below the second bull candle of that bullish Harami pattern, and with your targets in mind, you may want to target recent highs, but you can see that this trade in particular, if we move it all the way along, yielded a fantastic 8.2 risk reward trade from this bullish Harami we had here, and you can see how that trend's changed after that pattern started to come in and we got that RSI crossover. So this is a great way to use this bullish Harami chart pattern. Now, like most candlestick patterns, there's a logic to the ascending triangle pattern, and what we want to do is we want to find that breakout level and really enter a position once the price of the asset breaks above or below a certain level. In the case of an ascending triangle pattern, the upper trend line acts as the resistance level, and then we want to find a lower trend line which is trending in the bullish direction. So when we get these drawings on the chart, you can see exactly what I mean. We've got this rising lower trend line, and we've also got this upper trend line, and these lines are converging to form this triangle pattern. Now, what we want to do, first of all, after we've drawn the chart pattern, is we want to find that breakout candle. You can see we've got that here. So as a trader, maybe a position that you'd have taken could have been entering a long position at the closure of this candle with a stop loss just below the ascending trend line. You can do it at any point along these lows. Let's say, for example, we did it just below this ascending rising lower trend line of this triangle pattern, and you can actually see that we created new highs here, and we achieved a really, really nice 3.92 risk reward trade, and that's how you can use that breakout trading strategy in the ascending triangle formation. So much like the double bottom pattern, the double top pattern is mostly used to identify a trend reversal at the end of a previous trend. And in this example, we're going to see how the double top pattern can be used to form the end of an uptrend and signal the beginning of a new bearish trend. Now, as you can see on the chart right now, we're generally trading in a bullish direction. Now, what you can see here is we're looking for that M formation. With the double bottom, it was the W formation. With the double top, it's the M. So we mark our two highs here, and this to us, we've got the baseline of the M, we've got the two highs, and then we've got this neckline here. And you can see that those double tops have indicated there's potentially a change in trend. Now we want to wait for this breakout candle here, and as soon as we get a break below this neckline of this M formation, that to us is a signal that the market is changing trend. And you can see that breakout candle just here. You can see that one there and this one here, and you can see after that we generally started trading to the downside, and we had that change in momentum. So to be honest, the double bottom chart pattern is certainly its most effective when it appears at the end of a downtrend. And when this happens, we can see the price potentially reverse and move up higher. And I've got a really, really nice example on the chart. What we're looking for is that W formation. So you can see the neck of this W coming here. We can see the market clearly in a downtrend. But here we have low number 1 printed and low number 2. That creates our W formation, and then we start to move higher. As soon as we get a break above this neckline, this initial neckline, you can see how the market just sort of starts to run away, and then you can see the real momentum shift in this market. Okay, so let's look at how we can trade this symmetrical triangle pattern, and we can do it in a bullish or a bearish market. In this particular example, we can see the market is trending to the upside, so we can see this bullish example coming into play. Essentially what we're looking for is we're looking for a descending trend line and an ascending trend line, and when they meet and those lines converge, that tends to be when we get that breakout. So you can see an example here that we have this descending trend line coming down, and we also have this ascending trend line as well. We can see that we have this real squeeze in the market in this price consolidation period, but then we get the breakout. And us as traders can benefit from that breakout, because we can look to go long or short. If we broke out to the downside, we'd go short. We can look to go long with a stop loss just sitting below this wick here, so just below this ascending trend line. And you can see that this particular trade was a fantastic 5.56 risk reward trade. If, for example, the price broke down here, then we could just use exactly the same concept. We would go short at the breakout below this ascending trend, and then would go short of a stop loss just above the descending trend line, and exactly the same process. But you can see here a nice 5.56 risk reward trade from using those symmetrical triangle patterns.
Thank you for the analysis, Connor. As you can see, chart patterns come in all shapes and sizes, each with a specific function. For instance, bull pennants and bull flags are best suited for trend traders looking to buy a market. On the other hand, formations such as the double top and the double bottom may be easily integrated into breakout or range trading strategies. Ultimately, the choice is yours on which patterns and strategies to incorporate into your trading plan. Now, if you're new to chart patterns, we recommend that you begin with 3 of our favorites: the bull pennant, the hanging man, and the falling wedge. With these 3 formations, you can buy and sell any market on any time frame that you see fit. So what do you think? Are chart patterns right for your trading style? If our top 10 has piqued your interest, be sure to check out our comprehensive suite of chart patterns at howtotrade.com. We've just released a full module of chart pattern educational content on our website. Simply click below and check it out. Until next time, trade the action well, and we'll see you on our next live stream.